Ladies and gentlemen, welcome. Welcome to our next Lunch and Learn workshop, the next in our Lunch and Learn series, which has been fantastic for 2023. It's our practical and technical educational sessions, which is fantastic. For those of you that don't know my name, it's Paul Jansz, and thanks for joining us. We're here thanks to Hall Chadwick's Professional Partners Education and our fantastic supporters at Profit Master Global, iKeep, and Lloyd's Auctions. Massive shout out to Danielle Morrison. I'm sure Danny's online, as most of you have been invited here are friends of Hall Chadwick or Professional Partners Education, which is also known as PPE. It's probably Danny's last little lunch and learn. I'm not quite sure most people do know or don't know. She's due to give birth to her first child. So Danny, a massive shout out from all of us. We wish you all the best because it could be your last lunch and learn because you're ready to go. So all the best with your little girl. To all of you joining us, I know you're sitting there. There's a number of firms that also sit there in their boardrooms with their team members. So it's always fantastic. If you're joining us for the first time, welcome. Just a quick one with regards to Professional Partners Education. If you've missed any of our content over the last year and last year as well, we have a YouTube channel set up. It's PPE Plus. If you wanted to go on there, jump onto YouTube, type in Professional Partners Education, and you'll get all of the, call it the catalog of content. All of our Lunch and Learn series, so our technical sessions, our practical sessions are all online. It's all free. Go on there and subscribe. And you also get my Empire Masterclass sessions as well. So just jump into YouTube, type in Professional Partners Education, and it's all there for you. Again, free content for you to share with your team, CPD, whatever you wish to do with it. Now, today's topic, it's a different one. We're going to talk about navigating through the path of alternative lending. It's an interesting path. Here's a little bit of what we're going to cover before I introduce our guests. So we're going to cover types of lenders in this space, the current state of play, what we're seeing in terms of distress, the opportunities, the risks, and probably the do's and don'ts of private lending. That's probably a fairly important one, which we're going to finish on. We'll open up lines to anyone that wants to ask questions of our guest. We'll be online, 12:03. We'll be online for about 35, 40 minutes. So if you've got any questions throughout, drop them into the Q&A and we will get to it for sure. All right, there's a nice little intro. Let's get to our guests for the day. Nick Green from O Capital. Welcome, Nick. How are you?
Yeah, good. Thanks, PJ. I'm very well, thank you, and thanks for providing the opportunity to be a part of today's session.
Beautiful. It's our absolute pleasure. I know the last time we caught up was maybe a nice little networking lunch at Silks at Crown from memory.
It was, and I must admit, and I'm a little bit embarrassed by this, but it was the first time I'd been to Silks as a Melburnian. So it was a fantastic experience. Great to meet yourself and Roberto and the rest of the team and some of the firms that you guys align yourself with. So again, thank you for that opportunity as well.
Yeah, fantastic. And mate, I'm absolutely with you there. I think the problem in Melbourne is that we've got so many options, and especially at Crown, we've got so many options. But that was my first time to Silks as well. So
okay. So I wasn't the only one. That's good to know.
Not the only one, not the only one. Mate, before we kick off, how about, would it be okay if you shared a little bit about you, your head of distribution at Oak Capital, maybe share a little bit about you and Oak?
Yep, sure. So I joined Oak Capital about 3 years ago. Almost 3 years to the day. It was a couple of weeks ago now. Background has always been in lending, in specifically sort of focused on broker distribution, so the third party channel. And I've worked for lenders that the audience would know, such as, ING, ANZ, Commonwealth Bank. And then I sort of moved into the space of broker aggregation. So for those that aren't aware of what aggregation means or is, effectively, if you would like to be a finance broker, you need to select as part of your process an aggregator to partner with, because they're essentially the groups that provide you with the compliance and auditing support, the licensing, the accreditations with all the banks and lenders, because they're not held by a broker, they're held by the aggregator, as well as providing a technology platform for a broker to do their research and due diligence on products and make recommendations, etc. So I worked at a group called Plan Australia, which was a subsidiary of NAB for about 7 years. Until 3 years ago, where the opportunity to join Oak and help Oak Capital grow its distribution network came to life. And I made the jump and haven't looked back since. So that's probably a little bit about me and my background. By way of Oak Capital, we're what we call an alternative non-bank lender. that specializes in short-term business finance that's always backed by property. So we don't do unsecured lending. We always take a mortgage over a real estate asset, whether it be sort of commercial, residential, or even sometimes vacant land. And we can look at sort of specialized assets and income generating assets as well. But we always assess a transaction in its own merit. So whilst we may have a product guide and matrix that sort of steps you through some of the sort of headline products and rates, effectively, because we are a bit of a smaller group and a more specialized market, we will look at a loan scenario, the asset, the borrower, the purpose of the funds on its own merit every time. So that's a little bit about Oak Capital at a high level as well.
Brilliant, mate, and thank you. Yeah, look, I think it's an interesting one, because I suppose you tend to throw this around a bit, but what you don't know. And I suppose in this lending space or alternative lending space, it's an interesting one. So let's get into that. Let's talk lenders. What types of lenders exist in the alternative lending market space?
Yeah, great question. So I guess when you look at alternative lending, or to be fair, it's a term that the audience may be more across private lending. You need to sort of look at a snapshot of the market in general. So what I mean by that is you've sort of got what we call the first tier, which is your major banks, and like the likes of Macquarie, ING, Suncorp, etc. Then you have the second tier, which is where you sort of have your non-banks, your sort of traditional non-banks. So we're talking Pepper, Liberty, Latrobe, RedZ, guys like that kind of can tolerate a little bit more borrower impairment. The rates are slightly higher than first tier, but it's a sort of set and forget facility. They do loan terms of 25 to 30 years. And then we sort of delve into what I call the third tier. So the third tier market essentially has been set up and some time ago to service borrowers that don't fit in the first two categories, essentially. So what it means is when you look at deals in our space, there's typically a problem that needs to be solved where the appetite doesn't get serviced in the mainstream lending market. So whether that's impairment, whether it's, the borrower or director is a discharge bankrupt, whether they're going through or have gone through some kind of liquidation, defaults, whatever it may be, or the other side of it is there is a genuine, I guess, opportunity that is where time is of the essence, where effectively you're not going to be able to get funding for that opportunity within a matter of days by going through the other traditional means. So you would come to a short-term business funder like Oak Capital to be able to help secure that opportunity and get that done within the space of, say, a week. And put it on a short-term basis. So whether that's 3 months up to 3 years, whatever the individual scenario is, that's the sort of alternative non-bank space. And Oak have been a part of that for just over a decade now.
Okay, and that's it. So there's first, second, and third. That's it.
Well, there is a fourth tier, but it's probably not a tier that anyone wants to go into. That's probably more. If you look at the structure of Oak and some of the other lenders in our space, it's typically set up by way of a mortgage fund. So it's funded by investors. Okay. So we're not a bank, and we sort of use that a lot in our terminology with marketing. We're not a bank, and banks are typically funded by depositors. With short-term business funding, it's typically funded by investors. So whether that's through, a mortgage fund arrangement like what we have, or any other sort of means that's there, we raise money on a deal-by-deal basis. And to put it in layman's terms, it's effectively peer-to-peer lending. So a loan comes in the door, it's assessed, it goes through the credit and due diligence process. And yes, we do absolutely have that like a normal bank and lender would. We can just tolerate a little bit more from a risk standpoint. But when the loan's formally approved and we're ready to instruct solicitors, from where we sit, we will then go to our investor database, connect with them, share with them the valuation, who the borrower is, what the money's for, and a little bit about the story of what we're trying to solve. And it's almost like a first in, first serve. So we'll send that out to our investor base and they'll come back and say, yes, I'd like to invest X amount into this loan. Sometimes they take out the full amount. Sometimes we have, more than 50 investors in one loan. It just depends. Yes. But that's probably a little bit more around how the funding side of it works too. Okay. And the real difference between us and sort of mainstream lenders.
And a bank as such. Yeah. Interesting.
Correct.
Yeah, great. So what's the current state of play?
It's a great question. So Current state of play, I think everyone, you'd be living under a rock if you didn't
Yeah.
realize or be aware that there's been a number of interest rate rises. I think from memory, it was between 10 to 12 from last year. So I guess the current state of play around that is affordability for lending has reduced. In some areas, you've got property values going down as well. And you've also got lenders sort of taking a bit of a step back by way of risk too. So something that they may have had appetite to fund 12 months ago, they may have pulled out of that market completely. And a good example of that is development finance. If you were to sort of wind the clock back 2 years ago, most lenders from a commercial standpoint would consider a development transaction. Given what is going on in the building, I guess, market and the costs of materials, costs of labor, the impacts of COVID, that has sort of made most lenders, if not all, apart from sort of a handful, step out of the development market altogether. So there's a really good example of what the current state of play is around that. To your point at the start of the presentation, we are seeing a lot of distressed borrowers too. So the impacts of rates going up for existing borrowers, so not being able to afford their repayments, or in some cases, they get themselves in a situation worse than that. So there's certainly a lot going on. I think that if we look at short-term business funding, I think post-COVID and the impacts to small business owners throughout that period, private lending was really something that was done as a last resort because you kind of have to. I think post-COVID, with the impacts that's had on small business, it's actually brought private lending far more into the mainstream arena. And the reasons for that, it's being able to look at different and more riskier borrowers. But B, I think a big part of it is having the ability to capitalize interest repayments. So being able to come in, solve a problem, pay out an existing debt. If there's an exit strategy that makes sense by way of refinance or the sale of an asset, private lenders typically can capitalize interest for a portion or the full period of the loan, which gives some relief on the requirements to make repayments throughout the term and fix it up on discharge. So I think that's a part of it as well.
Okay, brilliant. Yeah, and I think that, you sort of mentioned before that distress, or that financial distress. I think there's, I saw it yesterday online and I saw it today in the paper, and, biggest creditor out there to most businesses are the tax office. So yep. They're starting to come down harder on businesses. And I think the comment this morning I saw in the paper was sort of businesses that have more than $100,000 of debt and defaulted, and they're in that financial distress situation, aren't they? So I think we've sort of worked our way out of COVID. I think the tax office has done a great job to give business owners the opportunity to do things. Yep. Obviously, on past sessions we've spoken about small business restructures as well, but that gives these businesses the opportunity to do something as opposed to sticking their head in the sand. And this is probably where that distress side is going to continue to come out a little bit, from what I can see anyway.
No, I think you're spot on. And look, I'm not an accountant. Obviously, there's a number of people that are joining us today that are. So I don't want to tell the audience how to suck eggs, and they'd be well across this detail. But just sort of speaking about the ATO, the last point I read was there's something around 120 director penalty notices being issued on a daily basis. The guys on the call will know what a DPN is, so I won't sort of spend time going through that. But we are seeing a lot of tax debt inquiry come through. From an Oak standpoint, we can absolutely take on tax debt, pay out tax debt. It really comes down to equity within an asset or assets. But by way of, I guess, risk appetite, we are more than comfortable with tax debt. And to be fair, if a company's got a tax debt, it means they're making money. So that's a really simple way for us as a lender to look at it and to come in and provide a solution. We are seeing inquiry come through for higher LVR as well, so loan to value ratio. And I think part of that is, the cooling off of property values. Yes. We're seeing a lot of inquiry around second mortgages. So, and again, we can facilitate a second mortgage. And, why would you go down the path of a second mortgage? It really comes down to just getting access to funds quickly and not wanting to take the first mortgage across to a higher interest rate with a private lender. Why not just borrow the amount that you need on a short-term basis on a second? Yep. We see things like serviceability issues. We touched on that before. The other one that I'm just sort of leading back to that current state of play, we're seeing a lot of incomplete construction. So we spoke before about the building industry. That there are some issues where you're sort of seeing that. I feel like weekly that there's a builder that's being wound up, and you guys are probably across that more than most. Again, we can look at a partially complete development site as a transaction. If the sponsor behind it, gives us some comfort, and we would come in and provide funding on those occasions too. So definitely a lot of distress out there. That's probably the theme that we're sort of seeing in market at the moment as a whole.
Yeah, that whole building construction market, we know when big players go under, we know that there's a lot of small players that are going to suffer because of it, and the knock-on effect is huge.
Yep, absolutely. And from a personal point of view, I'm supposed to be building a house next year, and I must say it's making me get a little bit worried. So anyway, we won't get into that. It does, yeah.
Especially when big names, it's like, oh God, yeah. I must admit, sometimes I'd love the opportunity to build, but then the stress of building as well, I'm not quite sure that I'm ready for.
Yeah, well, my wife and I have actually started talking about whether or not this is actually the path we want to go down now. Do we sort of change tact a little bit and look to purchase an existing dwelling? So anyway, I won't bore you with the detailed discussions on the home front.
So mate, tell me about the opportunities that are available. Are there opportunities?
Yeah, there are. Look, and again, the audience would be working with a huge amount of self-employed borrowers or companies out there. Again, by way of background, Oak Capital only lends to company entities. We don't lend to individuals. So we are a commercial lender. So the borrower needs to be a company, and the actual purpose of the funds needs to have a commercial flavor to it. And I just want to make that really clear. In looking at the opportunity, I think it's a couple of years old now, but a stat from say 2018 or 19, there was approximately 2.3 to 2.4 million small to medium sized enterprises that exist in Australia. They employ something like 98 or 97.5% of businesses employ people around the country, or people are employed by those businesses. And the Australian private debt market has recently reached over 133 billion. So it's a large growing part of the market. And I think, again, off the back of COVID, we're sort of seeing a huge amount of growth in our space. What I sort of say to, I guess, mortgage brokers, and I know that that's not the audience we've got here today, but I think for them, the opportunity is, from when I look at the numbers of our business, in the last 3 years, we've only settled loans for up to, I think it was about 345 brokers in total. Now, if you look at the overall population of mortgage brokers in Australia, it's nearly 20,000. So I guess the opportunity that exists in our space for finance brokers is they're not really competing with anywhere near as many brokers as what they are in the mainstream arena. It's a much more specialized and open market. So that's the opportunity for them. I think for the purpose of the audience today, it's really just understanding, I guess, where there may be a solution in our space to come in and play a role for things like tax debts.
Yep.
I can't stress enough, there are some risks involved in our space, and it's important to know who the lender is, who's actually lending the money, who's going to be registered on the mortgage, etc. Yeah. But when you've got a business like ours, fully licensed through ASIC, we run 2 mortgage funds, we've got 2 AFSLs and ACL, we sit on all the major aggregators. So you can sort of take a lot of comfort in the fact that, yes, we are a private lender, but you're dealing with a genuine, accredited and licensed non-bank lender that sort of provides short-term products. And I think, given the current market we're all looking at, and we talked about distress before, I think the main message from me is, if you're coming across distress and you're looking for a lending solution, and you've got an alliance with a mortgage broker, and I'm sure most do, yes, make sure you think of Oak Capital and give us a call, because we're really hands-on, and we're here to help, and we'll sort of help step through things around structures, and we're more than happy to engage the accountant, who fundamentally it's the accountant's client at the end of the day. They're the trusted advisor. Yeah, the finance broker's there to facilitate the lending. We will hold the hands of both parties to get the right structure in place as well. So I think that's what the real opportunity is for sort of the audience of today.
Yeah, good. Because I know I was with a firm last week. We were just having a coffee and we were chatting as well. Again, as you do, just having a chat in general terms. And yeah, look, they were seeing a few different, and just to paint a picture, they were seeing a few different, call it problems, that they were looking for solutions where clients, I don't know, I think it was a $3 million business. They're carrying debt because it's a part of what they're doing in terms of acquiring. Yep. So there's a bit of debt there, but there's also about 400K there of ATO debt. So they were sort of saying to me, PJ, so it's interesting that timing is perfect. So I'll make sure if they're not online, I'll make sure I send them the recording. But, they were saying, do you know of anyone in the marketplace that would look at that ATO debt? Because some of the other, let's call it the first or seconds that you were talking about, they won't refinance until the ATO debt is gone.
Yeah, correct. And again, that's effectively why short-term business lending exists. We're not, you don't come to us to put a loan in for 30 years. You just wouldn't do that because the interest rates are slightly higher because of the risk appetite associated with this. But we are there to absolutely provide a solution. And a lot of the time it is to come in and clear out debts, clear out defaults, clear out whatever it is that the borrower needs, so that they can then actually focus on going back to growing their business. So there's absolutely a borrower need and want for short-term business funding, particularly at the moment.
Yeah, good. So what are the risks that everyone needs to be aware of?
Great question. I sort of touched on it a little bit before. Like any industry, like any, lending business that's out there, by and large, everyone, does the right thing or tries to do the right thing. In our space, there is a bit of risk involved. It really, one of my bugbears is when a lender in our space sort of says they can do a transaction and they'll provide an interest rate that seems too good to be true. A lot of the time it is too good to be true. So I always stress to the broker or the accountant, or whoever it may be, make sure you read the terms and conditions and you go through them with a fine tooth comb, because a lot of the time you'll have a headline rate, then you might have a line fee, then you might have a loan management fee, then you might have a discharge fee, which in some cases can be a percentage of the overall loan amount. So it's just understanding the actual terms and conditions of the loan and making sure that you work out what the actual true borrower interest rate is. The difference that sets us apart from our competitors is the rate's the rate. So the headline rate, let's call it 9% for argument's sake. Yep. And we will charge a monthly fee of $100 to $200, depending on how it's funded. Outside of that, we don't charge any, discharge fees, a percentage of loan amount. That's just not us. The other one to keep in mind is upfront, commitment fees that are non-refundable. We see that all the time as well when brokers bring us, loan offers from our competitors. And what I mean by that is a lender could express a desire to fund a transaction. They'll organize evaluation report, which they won't release to the borrower, the broker, or the accountant. Suddenly the loan comes in and the LVR is too high. Sorry, we can't do the deal, but hey, that $20,000 that you've paid as an upfront commitment fee, it's non-refundable.
Non-refundable.
Yeah, which is a real bugbear of mine. Again, we don't charge any upfront commitment fees. It's just not what we do. And I think do your research is probably the third point. There's a lot of brokers in particular out there at the moment that are sort of claiming to be lenders themselves, when in fact they're not. They're effectively just a middleman that's adding a margin onto a loan that's being lended from somewhere else. So again, make sure you read the fine print, make sure you see who's actually being registered onto the mortgage. If you're doing research on a particular lender, I think websites that either don't exist at all or they don't provide details of who the management team are, who the BDMs are, they're not on any aggregator panels, big red flags. So there are some risks, but I think it's important, you can alleviate those risks if you're just dealing with the right people. I just sort of stress, whether it's Oak, whether it's someone else, make sure that you're dealing with the right people, that you can see their face and their name on their website. They've got all the accreditations, they're fully licensed, and all that kind of jazz. What are some of the other things? So, we talked about second mortgages before. Make sure if you're doing a second mortgage that, that doesn't actually trigger a default on the first mortgage, because in some cases that can actually be the case. Again, thinking about private lenders, make sure that lender is not funding to own, so that, that they're not just funding a loan so that they're hoping that there's some form of default. and they're just going to come in and try and take possession from day one. That's not the business that we're in. We have a customer care team that helps with any sort of post-settlement issues, including helping borrowers with the ability to make payments, etc. But there are some sharks out in market that the audience needs to be aware of.
Yeah, look, and that's I suppose the good part is that, yes, given the audience, the firms will be doing or helping their clients along this path, I suppose. But you're right. At the end of the day, the owners tend to sort of jump because they think it's going to be a short-term solution. But I think, to your point before, the risks are in the detail, the research, to look at all of that, to make sure you're not getting yourself into, it might be short-term for the next 30 days. It's going to cause you more grief in the next 2 years.
Yeah, correct. And, for us, a big part of it is the exit strategy as well. Yeah. So we're not going to lend money out unless the exit strategy makes absolute sense. Whereas there are lenders out there that won't even ask the question on what the exit strategy is. Exactly right. We're entrusted by our investors to lend out their money, and by doing so, they want their money back. So a key part of the scenario process is, help us understand how the money is going to be repaid, whether it's the sale of an asset, whether it's refinance. If it is a refinance, okay. If you come into us with a loan that's at another private lender that's already in default, how are they going to refinance outside of Oak Capital at the end of our term? If it doesn't make sense, we're just not going to do the loan. So it's just making sure you follow the correct processes, you ask the right questions, you know the detail, and you share all of the detail up front with the lender in question, so that the terms don't change at any point in time.
Yeah, well said. Finally, before we go to any questions, the do's and don'ts of private lending.
Yeah, sure. So good question. There are a few. So I'd be more than happy for I guess the portion of a slide deck I sent you earlier to sort of cascade amongst the audience, because I don't want to run through every single one of them, but we've already sort of touched on a few of them. So from a do's perspective, make sure you do your research. We sort of touched on that before. Make sure that do check that there's any early exit penalties. If they are, probably a bit of a red flag from our standpoint. If interest is capitalized, we can actually refund that interest if the loan's paid out earlier than the approved term. Do confirm that the private lender actually has the money to settle. This is a big one as well. We're seeing a lot of transactions come through to us at the very last minute because they've been set up and almost facilitated with another private, and then it gets to the day of settlement, and all of a sudden settlement's pushed out because they actually don't have the money to fund it. Which is terrible, really, but it does happen. So make sure that you check that. We've talked about checking the fine print, who's going to be registered on title, etc. I guess the other one is the don'ts. So don't sign a letter of offer unless the loan is proceeding. That's a big one. What you'll find is every private lender out there will have an application fee as part of I guess the terms and conditions. In most cases, once you sign a formal approval and provide that back to the lender, the application fee is applicable, even if the loan doesn't actually go ahead. Right. And when you're talking about facilities in the millions of dollars, and you're putting an establishment fee of say 1 to 2% in some cases, it's a lot of money, particularly if we're not actually giving the borrower the outcome. Yes. So make sure that the loan is absolutely proceeding before signing any documentation. Again, don't pay any large upfront non-refundable fees. Don't confirm anything on the phone. Always confirm everything in writing via email in the lead up to getting the deal done. And most importantly, don't forget to call out capital.
Well said. The bit where you said before about making sure the lender has the funds before, how do you find that out?
It's a really good question. Again, I think what you need to go back to is having something in writing. So you can't see inside the four walls of another lender. Yeah. And I think if you're dealing with a legitimate private lender like an Oak Capital or some of the other larger groups, then it's not really a risk you need to be mindful of. But when you're dealing with a business in our space that's offering terms that are too good to be true, and you don't have anything in writing confirming that the loan proceeds are going to be ready for settlement, that's a massive red flag. Yeah. So ask the question and get confirmation of it in writing, because at least if that way settlement is missed and there's penalties that sit behind that, it's not the borrower that's going to be up for those penalties. It's going to be the lender.
Yeah, well said. Ladies and gentlemen, if you've got any questions, please drop them into the Q&A bar, and we will look for the questions and we will answer them. Well, I'll throw them to Nick to answer. So if you've got anything that you'd like to ask, please ask away. Nick, while we're waiting for any questions to come through, are there any changes, or let's call it future changes, we need to be aware of that's coming through?
I think from what I see as a positive. There's going to be some changes to law with regards to contracts and being able to, I guess, or to remove the issue around unfair contracts. I don't know the actual name of the law that's coming through, but I think it's in November. And I think what that'll do is eradicate or remove some of the issues we've been talking about today with regards to having contracts that are only favorable to one party and not favorable to all parties. So things like, hidden fees and charges, line fees, fees to actually discharge a loan that sort of seem unreasonable, that sort of stuff. I think that's probably a real positive to look out for our part of the market.
Yeah.
The other one's probably, I think because the return on investment in mortgages is so high in comparison to putting a term deposit, putting money into a term deposit, I think that there's a lot of new players in market in the private lending space that are out there trying to get investors through the door. Okay. I think it's something to be mindful of. 3 years ago when I joined Oak, it was probably one of, say, 10 known private lenders out in market. I feel like that's doubled over the last 3 years. So changes coming in there. I think the unfair contracts piece may even get rid of some of those groups. But yeah, look, the only other changes I see is around credit appetite, really. So what the appetite is for a private lender today may not be the case in 6 months' time, and that's heavily determined by A, the market, and B, investor appetite. So again, it's not a set and forget market. Appetites do change. One thing that I can say from an Oak standpoint, things like tax debt, that'll always be part of our credit appetite. And I think that's really important for your audience that are online today.
Yep. Well said. Well said. Mate, what a great little session. Thank you.
Not a problem.
Looking for some questions, but there doesn't seem to be any there. So it's always a good thing where you can cover off everything we want to cover off and there's no questions. But if you've got anything you want to ask Nick, please throw it in there. And sort of like you said before, I'm pretty sure most firms will be working with brokers. I'm pretty sure the broker market has got the accounting market pretty well sewn up. But I think it's
absolutely,
again, what you don't know, which we started with, which was fairly important. If people want to find you, find Oak Capital, what's the best way to do that?
Yeah, sure. So oakcapital.com.au is our website. You'll be able to find everyone that's in the business there. My details are on the website under the About section where you can just go in and download my contact card. So that's probably the easiest way to get in touch with me. Happy to field calls from anyone that's on the line and answer any questions. The other thing I'd probably sort of say that if you are working with finance brokers, ask them the question, do you have accreditation with Oak Capital? Can you get accreditation with Oak Capital? Because, as I said before, we're here to provide a short-term solution to a problem, and we'd love to help out your SME borrowers.
Fantastic, mate. Well said. And look, I think again, I will definitely throw that set of questions from last week out to them and come back to you as well with some around that tax debt that I mentioned just before as well, because I think it could be a great little solution for them to look at. So, mate, thank you once again. Again, we've just gone to 12:35, so almost perfect timing with everything we wanted to cover today and giving everybody online the opportunity just to again, navigate their way through something a little bit different in this private lending space, the alternate lending space. So thank you very much. To all of you guys that have joined us, thank you again. Again, these sessions are a short, sharp little lunch session. I know with Melbourne going to daylight saving, I know Queensland, it's still the morning. So sorry about that, Queensland. But it's great to have some light late at night, isn't it,
Nick? Absolutely. Absolutely.
As we head into summer. Just another quick plug for my next Empire Masterclass, my live show on Zoom. We're talking about becoming an employer of choice. So I know in this employee market or employee-led market, how do you differentiate yourself? How do you build an exceptional workplace? How do you become an employer of choice? Do you even know what an employer of choice is? So I've got a very impressive guest, Casey Benjamin, that's joining me. It's next week, the 17th of October, 12 p.m. daylight saving time. So look out for the invitation if you haven't already get it. If you haven't already got it, please look out for that and sign up for that if you would like to join us next week on the 17th. Nick, thank you very much again. To anyone that wants to reach out, please make sure you reach out to Nick through the website, or you can find him on LinkedIn as well if you wanted to do that. So till I see you guys next time, thanks, and signing off. Enjoy the rest of your week.
Thanks, PJ, and thanks to the audience too. Appreciate you taking the time. Cheers.
Thanks, Nick.